Hi, I'm Ross from Coombe Smith 150 Group Property Accountants in Hamilton. I'm just going to go through a simple example of how you can save lots. In this example, we're saving over $10,000, over $10,000 a year in tax. So yeah, we'll just get into it. So we've got Jack and Jill. They are property investors. They both earn over 70,000, so they're on the 33% tax bracket. They've got a rental. They've got rentals in their LTC making 65,000 net taxable profit per annum. So that's income after all expenses, after chattels, depreciation, everything like that. They're still making 65,000 a year, which is their taxable profit from their rentals in their LTC. They've got no personal debt, so we can't be clever and try and restructure and move some of the debt from the personal home onto the rental because it's already debt free. How much do you think smart structuring could save them? And obviously, I've given you a little hint. We're over $10,000 to start with. So we'll go through this. A few more things. They've got 3 children, 14 years, 16 years, and 18 years. They support Jill's parents. So one of the key things, obviously, this is general information. It's not specific advice for you. And if you're looking at doing something like this, you like this idea, come and have a free chat with me. We do a 5 or 10 minute free chat that you can book online. It's a great way of just seeing what sort of things we can do for you and working out the best way forward. So organise one of those chats on the link. But yeah, definitely be careful with this. You need to get specific advice. Don't just rush out and do this yourself. So what we've got at the moment is Jack and Jill have got an LTC. They own the shares personally. So they have 50 shares each. They're getting 50% of the profit each. The long-term rental LTC is making its profit of 65,000, owned by Jack and Jill. This is a poor structure in this case. There's smarter ways that we can do this, and this is going to end up with a lot of tax paid. So the tax, both Jack and Jill are 33%, whether it's 99% Jack or 50-50 or 99% Jill or whatever percentage, it's not really going to matter because they're both on 33%. They're already earning over 70,000. So our tax at 33% is $21,450. So let's get smarter. Here's a different way we do it. What about if we look at changing the shares to a trust? And we need to be very, very careful doing that. There's lots of catches. We can trigger bright line. There's other ways that we can be taxed. So get professional advice like that. Come and see someone like me, property accountant, and we can go through how it works with it. But if we change the rental from the LTC, if we change the rental LTC from being owned by Jack and Jill personally, and instead we change it so the shares are owned by the trust. So we don't sell all the properties, we don't recover depreciation. What we do instead is save or we shouldn't recover depreciation. There is ways you can actually, but we change the shares. So it's going to save you a heap in legal fees, be a relatively simple transaction once we check the tax implications. Then what we've got is all the profit and loss from the LTC flows through to the shareholder, now the trust. The trust can allocate to beneficiaries. So we could look at children, lower income earning spouse, not in this case, both Jack and Jill over 70,000, but we could also look at Jill's parents in there. So we could have a range of different beneficiaries suiting our individual circumstance. We could also have the personal house owned by the trust. And one of the big things I love about the structure is it also gives asset protection. So if Jack and Jill are sued for health and safety tomorrow, this would protect their rentals, their personal house. And it's going to give us some great tax advantages as well. So we would look at allocating the income to beneficiaries. So we'd allocate maybe 14,000 to the 18-year-old. A key thing with this is the trust will owe that $14,000 to the 18-year-old. So it's really important that you look at the trust spending money on the child. And we'll go through that in other webinars or get some advice with me, but there's ways so that the trust can spend money so that, there's nothing actually owing there. The same, we allocate 14,000 to the 16-year-old and spend some money on them to offset it. If the beneficiaries are under 16, we can only allocate $1,000. So $1,000 to the 14-year-old. We've also got Jill's father. He's got no other earnings, so let's allocate him 14,000. It's only taxed at 10.5%, and we'd probably want to try and spend that on him as well. 14,000 to Jill's mother, and spending money on her. Jack and Jill are supporting Jill's mother and father, so they really will be spending money on them, food, accommodation, that sort of thing. So what we've got is now we've only got $8,000 remaining at 33%, and potentially we could look at allocating the two older children or Jill's parents some more income at 17.5. But I've just kept it simple. I've gone for the lowest tax bracket, the 10.5. We've got $8,000 left at 33%. The tax overall is now $8,520. So originally our tax was $21,450. The tax on the new is $8,520. We've saved $12,930 per year. And you might be thinking this is a bit far-fetched with the children and the parents, but lots of families are actually like this. There's often other people that you are supporting and helping. So potentially a trust structure could work, especially if you've got a high income from rental, something like 65,000 of taxable income. Be very careful. There's some real tricks with this, and the share transfers can trigger some major tax implications. So get full tax advice on this. And yeah, on our videos, I'll put a copy of the link in there. But basically, I would suggest organizing a free chat with me for 5 or 10 minutes. Just a great way to see, is there some little things that we can look at doing? Yeah, can we restructure? Can we move the debt around? Is there something smart that we should be doing? So organize a free chat, and obviously I'm property focused. So yeah, more around the property side, but if you are a business person who also does property, a lot of these concepts apply in the same way, and I can often help you with your structuring. And even if we don't do the accounting, I can put you onto an amazing accountant who can help you with the business side of it. So hopefully you've really enjoyed that, and hopefully you've got some good information. And yeah, so watch out for the next video, and hopefully it's helped you a lot. Thank you. Bye.